All right, let's dive right into a massive paradox that's playing out in the markets right now. We've got this really tense ceasefire in the Middle East, but at the same time, a super complex financial strategy called the volatility carry trade is making everything look deceptively calm. It's a crazy situation where stocks are smashing all-time highs while one of the most critical parts of the world is basically a tinderbox. This is what we call a volatility divergence, and it's where the market just ignores reality until the exact second it can't anymore. Let's break down this high-stakes balancing act.
So check this out. On one hand, you've got the S&P 500. It's hitting all-time highs, a scenario that a lot of people are calling priced for perfection. It's like the market believes absolutely nothing can go wrong. But on the other hand, you have the Strait of Hormuz. We're talking about a tiny strip of water where about a fifth of the entire planet's daily oil supply flows through. It is a vital artery for the global economy, and right now, it's a powder keg sitting under a very, very fragile ceasefire. And that is the great disconnect we're going to unpack. Wall Street's blissful optimism versus a simmering and potentially explosive global reality.
So here's our roadmap for today. We're going to start by exploring this great disconnect in the market. Then we'll dissect the short vol trap to see how this fake calm is being built. After that, we'll dig into the data to see what the market's really afraid of. Then we'll look at how the pros protect themselves. And finally, we'll talk strategy for how to navigate this whole stalemate.
Okay, first up, the market's great disconnect. We are talking about the dangerous chasm that has opened up between how the market perceives the world and what is actually happening on the ground.
So the key idea here is something called volatility divergence. And look, this isn't just a random fluke, it's a deep structural gap. What it means is the stock market is essentially putting its fingers in its ears and ignoring massive real-world risks, like the tension in the Strait of Hormuz. Now, why would it do that? Well, equity markets are often driven by broad sentiment and, more importantly, the flow of money, liquidity. But commodity markets like oil, they're different. They are tethered to the physical world of supply and demand. So a threat to the Strait of Hormuz is a direct physical threat to the oil supply, and that market reacts instantly. This divergence creates this weird, fragile sense of calm in stocks, even while the oil markets are screaming danger.
So how is this even possible? I mean, why isn't the stock market freaking out about the risks that are so obvious in the energy markets? Well, that leads us right into the anatomy of the short vol trap, where we're going to see how the market literally manufactures its own artificial calm.
Let's break this down because it's important. The short vol trap is basically a cycle that feeds on itself. You've got these huge institutional funds that are constantly selling volatility. You can think of it like they're selling insurance policies against a market crash. Every day they collect the payments, the premiums from these policies, and as long as the market stays calm, it's just a sweet, steady stream of income. But all of this selling pressure artificially pushes down the VIX, the market's fear gauge. So when you look at it, everything seems totally safe. But what's really happening is that it's like coiling a spring tighter and tighter. The more volatility gets sold, the more compressed that spring becomes, building up a massive amount of hidden energy that could be released in one violent snap.
Now this right here is the engine room. This shows us how the whole trap gets funded and, more importantly, what could make it all blow up. It's a four-step chain reaction. First, it all starts with the yen carry trade. For years, Japan has had interest rates near zero. So imagine you could borrow billions of dollars for basically free. That's exactly what huge funds do. They borrow Japanese yen for next to nothing, swap it for US dollars, and then invest it. This just floods the global market with a fire hose of easy cash. And where does a lot of that cash go? Right into the strategy we just talked about, betting against volatility, pushing down the VIX. But here's the trigger. If Japan, which is now facing its own inflation, decides to raise interest rates, that free money spigot gets shut off. Instantly. The big funds have to unwind that entire trade. They have to sell their US assets to buy back yen and pay off the loans. This just sucks liquidity right out of the system. And for the vol sellers, their funding just vanished. They're forced to start selling stocks to cover their bets, and that can set off a domino effect, a massive, rapid market sell-off.
Okay, so that's the theory. But what are the numbers actually telling us? Can we see this manufactured calm in the data? Can we see the fear hiding underneath? Oh yeah, absolutely. Let's dive into the data and see what's really going on.
This slide just lays it all out, plain as day. Take a look at the data from mid-April 2026. The VIX, the stock market's fear gauge, is at a sleepy 10.80. That is crazy low, signaling just absolute, total complacency. It's the market equivalent of taking a nap. But at the exact same time, the OVX, which measures fear in the oil market, is at a staggering 73.04. That's not a nap. That is a 5-alarm fire. That isn't a gap, my friends. That's a canyon.
and it's signaling massive, undeniable risk in the world's energy supply.
And this bar chart just makes the whole thing look absurd. The visual is just undeniable. On the left, you've got this tiny little sliver of fear in the stock market, way down at 10.8. And on the right, you have a towering skyscraper of fear in the energy markets at over 73. These two markets, which are supposed to be reflecting the same reality, are telling two completely different stories. And that begs the question, which one is right?
And here's the real kicker. It looks like the market doesn't even believe its own story of calm. This table shows something called the VIX term structure. So while today's VIX is super low, near 11, just look at what it costs to buy protection for the future. May's contract is up at 18, June's is over 20, July's over 21. Think of it this way. The market is telling you that while a bottle of water costs $1 today, it expects it to cost $2 next month and $3 the month after. This upward slope has a name. It's called contango, and it shows that traders are pricing in way more fear down the road. It's a clear signal they're bracing for a storm, even if the skies look clear right now.
So, let's recap. We've got a market that's calm on the surface, but the data is showing a massive disconnect, and the market itself is pricing in a future storm. This creates a really unique opportunity. I mean, if you know a storm is probably coming, but insurance is still being sold at sunny day prices, what do? Well, that brings us right to our next section, the professional's insurance policy, where we see how to hedge this risk for pennies on the dollar.
This quote absolutely hits the nail on the head. It perfectly captures the difference in mindset. You see, retail traders, they often act on emotion. They rush to buy protection, like put options, when the market is already in a nosedive and panic is everywhere. But by then, that insurance is wildly expensive. The pros? They play a totally different game. They're proactive. They buy their insurance when everyone else is relaxed, when the news is good, and when that protection is dirt cheap.
And here it is, side by side. The retail approach is reactive. It's panic buying, expensive protection after your portfolio has already taken a huge hit. The professional approach, though, is proactive. They see an extremely low VIX, like that 10.80 we're seeing now, as a giant flashing neon sign that says portfolio insurance on sale. They buy it cheap precisely because everyone else is complacent and looking the other way. It's all about buying fear when it's cheap and selling it when it's expensive. So how exactly do the pros do it? It's a simple four-step playbook. First, they wait, patiently, for the market to get extremely complacent, which is signaled by that very low VIX. Second, they buy cheap, out-of-the-money put options. Think of this like buying catastrophic insurance for your portfolio. Your normal car insurance covers a fender bender. An OTM put option doesn't. It only pays out if your car gets completely totaled. And because it only covers the huge disasters, the premium is incredibly cheap. Third, this creates what we call an asymmetrical hedge. You have a small, fixed cost, the premium you paid, for a potentially massive amount of protection. It is the textbook definition of buying flood insurance when it's sunny outside, not when the hurricane is already offshore.
Okay, so let's tie this all together. We've looked at the problem, the mechanics behind this fake calm, the screaming signals in the data, and the professional strategy for protection. Now let's turn all of that into a clear, strategic outlook for navigating this really tricky stalemate.
So what should you be watching? Here are the 4 key things to keep on your dashboard. First, the VIX term structure. If that upward sloping contango suddenly flips to backwardation, meaning near-term fear gets more expensive than long-term fear, that's a huge red flag that panic is setting in right now. Second, that gap between the VIX and the OVX. The wider that gap gets, the louder the signal is that equity insurance is on sale. Third, keep a close eye on the S&P 500 at 6,740. That's a key technical level where a lot of automated selling programs are set to trigger. A drop below that could open a trapdoor. And finally, and maybe most importantly, watch Japanese interest rates. Any hike there could be the single catalyst that unravels the entire yen carry trade and pulls the rug right out from under the market.
And here's why things can fall apart so incredibly fast. Today's markets aren't run by people yelling on a trading floor anymore. They're run by algorithms in a server farm. And many of these algos are programmed with a simple, brutal rule. If oil prices spike, sell stocks, period, instantly. A single headline from the Strait of Hormuz could pause that oil spike, which then triggers a chain reaction of code that sends the S&P 500 tumbling in microseconds, before most people have even finished reading the news alert on their phone.
So here's the bottom line. You've got the geopolitical tinderbox, you've got the coiled spring of the short vol trade, all funded by a fragile carry trade. And you have data that is screaming a warning that one market is systematically ignoring. It all paints a picture of a system that is actively choosing to ignore a clear and present danger,
lulled into a false sense of security by these financial tricks. But history has taught us over and over that this kind of denial never lasts. The market will ignore reality right up until the moment it can't anymore. The only question is, will you be prepared when that moment finally arrives?